All right, so don't look now, folks, but 401ks are coming under a tremendous amount of scrutiny. Now, the heat coming from both economic and political angles. In April, this headline blasted 401ks, citing an article in Political, which itself cited research from the Federal Reserve. In fact, the Consumer Survey Finances in the Federal Reserve has saw that the average family had a retirement account of about $87,000. But as you look more granularly at it, by income, there was the gulf was vastly different. The top 10% at $558,000, the bottom 39% to 20%, just $20,000. Recently, Vanguard, in an effort to sort of get in front of this issue, they put the onus on employers. In a report out here recently acknowledging that 401ks are lopsided, with top earnings participants receiving the most share of the employer contribution. You can see it here. So if you put in the most, the folks who earned the most not only participated more, but they got a far larger share of the contribution from the company itself. Now, the report did note, however, that even within income brackets, there were just simply some people who were more aggressive than others. 1/3 of the folks in every bracket seemed to dominate. I wanted to bring in Wealth Enhancement Group, Senior Vice President on this, Nicole Webb, because, Nicole, this is really serious stuff, right? And Vanguard said there were 3 ways that employers could maybe, help level the playing field, so to speak. What are your thoughts?
Our firm specializes in plan design for business owners of lots of different sizes. And I would say we do put the plan design onus on how do you use the retirement plan as part of the total compensation package for your employees to highly incentivize participation. And so a lot of that comes down to what you were showing in the Vanguard study around modeling and how an employer contributes towards an employee's future retirement. There's a lot of costs embedded in 401k plans. And so when you think about being an employer, you want to navigate on the behalf of your employees how you spend the money that goes into plan design and ongoing maintenance. Right. But Charles, I think the most important thing as we see more headlines around 401ks is they were never designed to be your retirement plan. This one account
They were a savings plan, not an investment plan. Those are two distinct different things.
Two distinctly different things. They were the third leg of a stool. It was Social Security. And then what was more common when there was the inception of the 401k, which was a pension, the second leg, and then the third leg was this savings account, that excess bucket for additional liquidity that you could tap into over and above 2 fixed income streams. Now it's a lot of the onus of retirement savings has been put on the employee and only on the employee. And so it's really about getting ahead of, don't make that the only place you're saving money. Right. And how are you building out the 3 legs of your stool now?
So the bottom line, though, is that most folks watching need to go beyond just having a 401k.
Absolutely. And I would say for most folks watching, don't leave money on the table. Most employers are using the retirement plan as a part of your total compensation when they think about the cost per employee.
Right.
And that generally requires, as you see in this Vanguard study, that most employers are requiring their employees to contribute to get something in return.
This year, there was a major change in the Roth. I always tell people Roth over traditional IRA. What do you tell them?
Always. Yeah, the Roth IRA is so special, and the Roth 401k doesn't have earnings limitations around it. And so for those who have access to a Roth 401k, you don't have to worry about the same earnings levels that you have to worry about in a traditional 401k. Now, the 2 major changes to Roth 401ks are there's no mandatory distributions at future retirement ages. And second to that, employers can now do their matches to your Roth 401k, which didn't used to be the case. So lots of incentives if you're willing to pay the tax today to not owe any tax in the future, which is a benefit, a massive benefit when you think about the growth.
It really is. Once you jump that hurdle and then you just grow that pile of money, that's what you really want for your golden years. But let's talk about the market for a minute. I got less than a minute to go, but just a moment ago, the S&P 500 hit a new all-time high. Sort of a stealthy move considering the last 2 weeks it felt like touch and go. But all eyes on the Federal Reserve. You would like to see the Fed cut rates sooner rather than later.
Yeah, I think that the environment we're operating in is almost demanding it. And it feels like the Fed is a little bit stuck. You know, one of the key items that we point to is housing. We are not in a period of time where we have housing equilibrium. And in fact, we're actually really far away from it, meaning there's a multi-year undersupply, and we're not seeing enough new home starts because we're not in an interest rate environment that supports it. At the same time, higher interest rates are printing huge income for people who have access to fixed savings. And so you're seeing some of that in the stickiness around services inflation, as an example. And so, you know, starting to methodically shave down rates, let the market adjust, and instead of going into a rate cutting cycle, let's focus on a normalization of rates, which is a very different undertone in what we should expect, which is moderate growth, a stabilization cycle for interest rates, and hopefully that drives us toward periods of equilibrium.
I'm going to get the hook, but for you, because a lot of folks are saying, hey, if you go back 100 years, this is where we've been. 4.5%, 5% is normal, stable, whatever. What do you think where's the sweet spot for you with respect to maybe inflation and Fed funds?
Yeah, you know, I think that it's hard to look back and say that the past is the right place. And I'm sorry,
especially when you go back 100 years.
You know, and society has changed so much. We have dual income households, we have single income households, we have a cost of living. We haven't necessarily had wage inflation over the last 30 years that has kept pace with these adjustments because we've moved towards a dual income household. And so I think there's a lot that goes into it. What we need to find is a pathway towards equilibrium, because a huge part of the psyche of people and the consumers, the biggest part of our economy, is the money that is wrapped up in housing and the accessibility of housing and home ownership in this country.
And the bottom line is, for you right now, rates are too high, bottom line.
I would say that, yes, it's time to start inching our way towards.
I love this information on the 401ks. This is a bedrock for so many folks. Between housing and 401ks, we are talking about what people are banking on for their future retirements and for their children and their other generations. Thank you so much.
It's a huge deal.
Really
Thank you,
appreciate it.
Charles.
Okay.